Everyone, hi. Okay, just starting a bit earlier as usual, just to make sure everything is working fine. Okay, cool. I think everything should be working fine now. Okay, cool. They've started it on the app, so we're good to go. Hi, everyone. Okay, so once again, hello everyone, and welcome to today's exclusive webinar brought to you by Vantage. I'm thrilled to have all of you here because this is one of the timeless trading topics that every trader, no matter if you're new or like you've been here for a long time, you do need to, master this. Okay, so the question is, do we follow trend or do we counter trend opportunities? We're gonna find out within this 1 hour webinar. So before we dive in, let me just say I love that my webinars are a little bit more interactive. Okay, so I do want to find out like how's everyone doing today? I'm talking more to the people on Zoom rather than the Vantage app because everyone can see the app, right? It's moving like crazy. The chat is constantly moving. There's 950 of you on the app, and there's only like 20 to 30 of you on Zoom. So yeah, mostly to the people on Zoom, and even on the app, you can say hi. I'll try my best to catch your message. Okay, how is everyone? How's your trading week been so far? And just for fun, let me know in the chat, are you more of a trend trader or secretly love catching tops and bottoms? Let me know in the chat box. Okay, trend trader, trend trader. I like to follow trend. Thank you so much for answering. Yes, similar to me, I also like to follow trend. Okay, this is the beauty of trading. There's no single right answer. Some traders thrive following the trend, others prefer fading moves for reversal. So what matters is having the right tools, the right mindset, and the right risk management so you can survive whichever style you choose. Okay, so both works. It's just as long, it doesn't matter what your style is in trading, as long as it's making you money, that's most important. Okay, all right, before we get into the main content, let's pause for the disclaimer. Okay, I know some of you have been in these webinars before. You'll be familiar with this part. I just want to take a moment to really emphasize it because it sets the tone for today. Okay, everything we discuss in today's session is a reminder that it is only for educational purposes. Okay, it is not investment advice, it's not financial advice, and it's definitely not a signals group. I'm not here to tell you exactly when to buy or sell or to hand you a list of trades to copy. That's not what this is about. Instead, the goal of this webinar is learning. It gives you the framework, the tools, and the insights that you can take away and apply in your own trading. So every trader is different. You have different risk tolerance, different time frames, different capital sizes. So the idea here is not to tell you what to do, but to equip you with the knowledge that helps you make your own informed decisions. So let's be very honest. Trading can feel very overwhelming. You're bombarded with information from social media, from news outlets, from random Telegram group, from whatever it is, okay? To have and all these people are saying they have the holy grail strategy. But the thing is, here in this webinar, the purpose is different, okay? The purpose is to slow things down, strip away the noise, and to focus on principles that actually matter. So as we move forward, I encourage you to treat this as a learning space, take notes, ask questions, and think critically about what I'm sharing. At the end of the day, the whole point of Vantage hosting webinars like this is to provide you, the trader, with a place where you can grow, improve, and to see the markets from a different perspective. So once again, remember, okay, please remember, this is purely educational. It's not advice. What I share is based on my own experience and my own approach. You are in full control of your own trades and your own journey. My role here is simply to share what has worked for me and what might work for you. Okay, you can become more confident and more consistent in your own trading by learning different things and trying to apply different things through backtesting. Okay, so before we dive in, as usual, I'm going to introduce myself. Let me take a moment to tell you who I am. Okay, my name is Cassandra. You guys can call me Cass. It's a little easier and less formal. Okay, I like to keep things friendly in these sessions. I am an investment analyst, also a prop trader. That means that I'm not just analyzing the charts from the sidelines. I'm actively in the markets every day, managing risks, taking trades, and consistently adapting to what the markets throw at me. So on the analyst side, I am with a research firm called Everest Fortune Group, which has been recognized globally as a finalist for the best Forex and equity research multiple years in a row. My role there involves deep market research from macroeconomics analysis to technical price actions, and breaking it all down into strategies that traders can actually use. On the prop trading side, I put my own skills to the test by trading with real capital, and trust me, when your own money is on the line, discipline and risk management stop being abstract concepts. Okay, so they become daily survival skills. Everything I share with you today isn't just theory from a textbook. It's something I've had to practice and refine in real trades under real pressure. So the reason I share all this is not to brag, but to give you confidence. You can be assured that what we're discussing today comes from both research and real-world trading experience. My goal is to make sure you leave this session with insights that are practical, relevant, and applicable to your own trading journey as a trader. Okay. Our agenda for today, this is basically the roadmap for today's session. We are going to start with how to identify true trend early, because if you can recognize a genuine trend before everyone else jumps in, you gain a huge edge. Next, we'll look at the art of counter trend trading, and specifically how to do it without blowing up your account, because let's face it, fading moves is dangerous if you don't have rules. So it's always dangerous to go against the waves, right? If you're jumping into the ocean to swim, you don't want to be going against the waves. You want the waves to carry you to your destination. Okay, so thirdly, we'll explore indicators that actually work when it comes to trend identification. And I'll say this now, not all indicators are created equal, but a few, if used correctly, can be very effective. Okay, and finally, we'll end with a practical discussion on when to switch between trend and range strategies, because no market trends forever. Sometimes knowing when not to trend trade is more valuable than trying to force a trade. Okay, so if you guys have any questions throughout the webinar, it doesn't matter, as long as it's trading related, just ask me in the chat box. You guys don't have to be shy. You don't have to feel like, okay, what my question is not related to today's topic. Just ask me questions. Again, just a reminder that the whole point of Vantage doing these webinars for you guys is to, help you guys, let you guys have a platform, like a place where you can go and ask a professional trader, ask someone who is very experienced in the market, and basically share your challenges and hopefully get help that you need to become a better trader. Okay? So let's start with today's topic, which is how to identify a true trend early. So when we talk about identifying true trend early, the first step is identifying what actually makes a trend real. A lot of traders mistake temporary moves for trends. For example, just because price moves up for 2 candles doesn't mean it's a new uptrend. Similarly, a sharp drop doesn't mean the market has suddenly reversed. A true trend is when the market shows a consistent pattern of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. But it's not just the shape of the candles. True trend is also backed by momentum and participation. So if you see higher highs forming, but each push is weaker and slower, that's a warning sign that the trend may not last. Okay, so if you see moves with conviction. That's when you know the market is being driven by real interest, big players stepping in, not just retail noise. So to spot a trend early, you need to look beyond the surface. Ask yourself, is this just a short-term push, or is there evidence of real control by buyers or sellers? So the earlier you can spot that control, the earlier you can position yourself in the move. So let's just go through what higher high and higher low means. I need to pull out my pen. Okay. I mean, I've set examples here. So lower lows is when price is making these lower lows. Okay, very obvious lower lows. Okay, sorry, this first one was not meant to be. Okay, this lower low, this lower low, and then this lower low. And it's also making lower highs. So you can see very clearly that price is definitely moving in a zigzag, where that zigzag is forming lower highs and lower lows. This is a clear definition of what a downtrend is. Similarly, for an uptrend, if price is moving upwards, okay, if price is, sorry, my pen keeps disappearing. Why is my pen disappearing so much? Okay, there you go. Okay, if price is moving upwards and you see price making higher highs and higher lows, this is a clear indication of an uptrend. Price is clearly moving up in a zigzag pattern, and it's clearly forming higher highs and higher lows. Okay, so it's a very clear distinction of like uptrend and downtrend. But there will be times where price is moving like, okay, it's moving like this. For example, this making higher highs. Then not making a high, and the next one is high. So is this still an uptrend? Okay, in this case, it's a little trickier. You can see price making higher highs, and then suddenly it doesn't make a higher high anymore, and then it makes one again. Okay, so it could be that during this period, momentum was low, or there was no volume, or whatever it is. But overall, you can see price still making higher highs. As long as it's still making higher highs, as long as it's still making higher lows, then you are good. We are still considering that as an uptrend. Okay, so far so good. Okay, cool. Gonna move on. So now let's talk about the actual tools that can use to identify a trend before it becomes obvious to everyone. Okay, sorry, just letting them know that everything is working fine. Okay, cool. So the first tool is market structure. One of the earliest signals of new trend is the break of a key swing high and swing low. So for example, if the market has been in a downtrend and suddenly breaks above the last lower high, that's often the first sign buyers are taking control. If you wait for too many confirmations, you miss the early part of the trend. The second tool is, you can also use other things like moving average volume. We can look at that later on. Okay, but basically, there are different ways where you can identify if you are in fact in a clear uptrend or downtrend. So it's basically the break of structure where there was this swing low here, and then this is considered break of the structure. Price comes back and retests that structure. Okay, good. And then it continues to break. This is a clear downtrend. So this is exactly how you identify downtrends and uptrends. It will help you tremendously. Okay, I'm going to tell you guys right now, straight up, okay? Today's topic is very simple. It's very basic. It's very basic. It's very simple. But let me tell you something. If you cannot master trend, I feel like you're in a losing battle. because I always tell people, I tell this in almost all my webinar. Every time I go on the charts, I go on TradingView, I pull out EUR/USD, for example. The first question I ask myself as a trader, I always ask myself this before anything else is price moving up or is price moving down? That is the first question I will always ask myself as a trader. If I can answer this question accurately as a trader, 50% of the battle, for me at least, I feel like 50% of the battle has already been won. Okay? I feel like 50% of the battle has already been won. Why? Because if price is moving on a downtrend, then I will enter for a sell. If price is moving on an uptrend, then I will enter for a buy. It's really that simple. Okay, then later on, after I have identified trend, then I will ask myself again as a trader, okay, now that I know that price is going down, I ideally want to get in for a sell. Where do I get in for the sell? Right? It makes sense, right? It's a structured system where you first ask yourself, is price going up or down? Okay, the answer that you get up means that, okay, if it's an up, I'm getting it for a buy. If it's down, means I'm getting for a sell. So that's, you got your first direction in trading already. And then now your second question is, okay, now that I know I'm getting it for a sell or a buy, where do I enter for that sell or buy? So then now you pull out other things like support and resistance, like Fibonacci levels, like whatever, okay? Okay, so moving on. Identifying a trend early is only half the battle, which is already good. It's half the battle won. Okay. The other half is knowing how to position yourself without overcommitting too soon. So the best way to approach this is to start small. When you see an early sign of a trend, okay, take a smaller position, take better risk to reward trades. Okay, if the move continues to confirm itself, then you can add your position as you go. Okay, this way you're participating early, but you're not risking too much on what could still be false start. So for your stop loss placement, don't suffocate the trade with ultra tight stop. Place your stops beyond the most recent structure. For example, if you're buying into a potential uptrend after a breakout, okay, your stop should go below the breakout level or swing low. This gives your trade room to breathe, okay? Because trend rarely move in straight lines, okay? It usually moves in a zigzag pattern. Okay, finally, accept that not every attempt will work. Every trend entries come with risk of false starts. Sometimes price looks like it's trending, but it fizzles out. That's okay. The trick is to manage your risk so that the few small losses don't wipe you out. And then when the real trend comes, you're in position to capture it. So early entries are about patience and risk control. If you do it right, you'll catch trend while they're still young instead of chasing them when it's too late. Okay, so I'll give you an example of what to do. So let's say you see signs that there is a trend reversal. I don't know how you manage to see the signs. It could be a moving average. It could be Elliott wave. It could be, they're just signs, okay? It could be fundamental analysis. Whatever it is, there was something that was telling you that, hey, there is a possible trend reversal. So you're kind of confident that's going to be a trend reversal, but you're not 100% sure, obviously, because you're never, ever going to be 100% sure in trading. You just feel like you're kind of sure. So then you get in, but you don't get in at your normal risk to reward. Okay, so your risk to reward, let's say you usually risk 1%. You don't get in at your normal risk, so 1%. Let's say you have a $100,000 account, 1% of $100,000 is $1,000. So usually you will risk $1,000 on a $100,000 account. This time, because you're not very sure, you kind of have a hunch. You kind of have a hunch that, okay, trend reversal is going to start, but you're not like, you don't know for sure. So maybe you can start by getting in with 0.5% risk or even lower. Okay, so that's how you keep your account safe. That's how you stay in this trading game for long. And that's how, yeah, etc. Okay, so Um, do try to master. I'm not even saying try, you must. You must master trend, identifying trend if you are going to be a trader. Okay, it is so important. I mean, I personally do not know any indicator, any way of trading where you not knowing the trend is not important, right? I think if you guys have some way of trading without not knowing the trend, let me know because I want to try it too. Okay, so the next topic will be the art of counter trend trading without blowing your account. If you guys have any question, can you guys let us now before I move on to the next topic? Today's topic is again very simple, very straightforward. It's very basic, so I will be able to finish it quite early. Okay, I'll probably be finishing in like 20 or 30 minutes. So just ask me questions along the way. You won't really be eating into the webinar because today's topic is so basic that we will have a lot more time for Q&A today. Okay, so I've got a question already. How do you avoid getting trapped in false breakout when trying to follow a trend? Okay, very good question. So the best way is to wait for confirmation, like a retest of the broken level or volume backing the move, for example. Okay, if a breakout happens on weak volume or without follow through, chances are it's a trap. So the answer is patience is key. Let the market prove itself before committing. Okay, I've got another questions. Do trends behave directly in major pairs versus exotic currency pairs? Very good question. The answer I would say is yes. Major pairs like EUR USD tends to have very clean, steadier trends because of high liquidity. Exotics can be very volatile and choppy with lots of like false signals. Like in exotic pairs, you need wider stops and extra caution, while major pairs allow you tighter, more structured trend following. Okay, that's why I personally only trade the majors. I don't really look at the exotic pairs because number one, the spread is so bad. Number two, like it's a little more volatile. Okay. Okay, I'm gonna continue. Okay, so let's start with the honest truth. Counter trend trading is one of the most dangerous strategies in the market. Why? Because you fade a move, meaning you trade against the current trend. Okay, you are literally stepping in front of momentum. Think of it this way. If the market is strong uptrend, it's like a train moving at full speed and then jumping in front of it to call a top is risky. You know what I mean? Yes, you might catch the reversal, but look like a genius. But if you're wrong, the train runs you over. Okay, so the risk is that counter trend setups often give false signals. Price might look like it's reversing only to continue the original trend and stop you out. So this means your win rate is usually lower compared to trend following strategies. Another challenge is the risk to reward profile. Often counter trend traders capture smaller pullbacks compared to the large extended moves you get when you follow the trend. That means that if you're not careful, your losses can be bigger than your wins. Okay, so why do traders still attempt counter trend trading? Because when it's done well, it can be profitable. And it's very tempting to try to catch tops and bottoms. The key is to do it with rules, discipline, and a strong respect for risk. Okay, that being said, I do have a story to share with you guys. I personally know someone. Okay, we were both trading EUR USD. So we were like bouncing off ideas. We were bouncing ideas off each other. Okay, I was telling him what my thoughts are for EUR USD. He was telling me what his thoughts is for EUR USD. Every time I'm calling a buy, this guy is calling a sell. he was counter trend trading, and you know what? At the end of the day, we were both correct. We were both profitable. I ended up making profits from my buy, and he ended up making profits from his sell. So it's risky, but if it works for you, you can make it work, then just make it work, right? So this is an example of counter trend trading. It's a very good example. This is actually exactly what happened with me and that guy. I was trading this entire uptrend, and he kept trading this. He keep getting in and out. He takes profit, then he waits, and then he waits to get in here, and then he takes profit. He waits to get in here, and then he takes profit. Okay, I personally do not like to keep coming back to the market. So for me, counter trend trading is not it. Okay, I cannot do counter trend trading. Okay, because I prefer doing that entire move up. That makes more sense to me. Okay, so if counter trend trading is so dangerous, how do you do it safely? Okay, very good question. The first rule is to wait for exhaustion signals. Don't just short an uptrend because price looks high. Instead, look for technical clues that the move is running out of steam. This could be a long wick rejection candle, a bearish engulfing at resistance, a momentum indicator showing divergence. For example, the example that I showed, price makes higher highs, but RSI or stochastics or whatever oscillator you are using makes a lower high. So the oscillator is already showing you that there is a possible trend reversal. So then you need to be cautious when there is trend reversals. I mean, you need to be cautious when you see all the signals. Okay, so secondly, to start small and scale in cautiously, don't go all in on your first counter trend entry. Take a small position, and if the market starts confirming your idea with follow through, then consider adding. If you're wrong, the small size keeps your loss manageable. Third, use a very tight stop place near structure. In counter trend trading, you don't want to give the trade too much room. If you're fading an uptrend at resistance and price breaks above that resistance with strength, your idea is invalid. So cut it quickly. And finally, aim for modest profit targets. You're not trying to capture the next 1,000 pips reversal. You're not trying to catch the entire weekly swing high to swing low. I mean, unless you are a positions trader, okay? If you are a day trader or a scalper, be realistic. You're looking to take advantage of short-term pullbacks, maybe to the moving average, maybe to the previous support, whatever it is, whatever strategy you are using. Just be modest with it, okay? If you get greedy, you'll hold too long and the main trend will eventually resume against you. So safe counter trend trading is not about home runs. It's about small, precise plays that add up over time without blowing your account. Okay, so the last piece of counter trend trading isn't technical, it's psychological. Many traders, okay, blow up not because they misread the charts, but because of ego. Okay, they want to be the hero who called the top or the bottom. They fight the trend blindly because they think they're smarter than the market. And the market has a way of punishing that attitude. Okay, let me tell you something. The market, okay, the Forex market, okay, moves trillions of dollars on a daily basis. Yes, you heard that right. The Forex market moves trillions of dollars in like a 24 hours period. So by the time you wake up and go to sleep the next day in 24 hours, trillions of dollars have already moved while you were sleeping. Okay, so if you are going to have an ego while you are trading, I can tell you you're not going to last in this industry because the markets will humble you very quickly. Okay, it will humble you. It doesn't care about your $1,000 account. It doesn't care about your $10,000 account, your $100,000 account, your $1 million account, your $10 million account. That's peanuts compared to what is happening in the market on a daily basis. So you must always trade with humility. Okay, the truth is counter trend trading means accepting a lower win rate. You won't be right most of the time, and when you are right, you should make enough to cover the losses. This requires a lot of humility, patience, and an ability to take small losses quickly without hesitations. You also need to shift your focus away from trying to predict the exact turning point and instead focus on discipline. Okay, your job is not to outsmart the market, it is to manage your risk while testing high probability reversal setups. Okay, and above all, always respect the main trend. Even if you're fading it, remember that the larger force is stronger. Okay, don't hold onto a losing counter trend position thinking the market has to turn eventually. Okay, the market doesn't have to do anything for anyone. Okay, your job as a trader is to align with what it's actually doing. So the golden rule is this: if you're going to counter trend trade, do it with humility, discipline, and strict risk management. That's the only way to avoid blowing up. Just remember the markets are not moving for you, it's not moving against you. The market doesn't care who you are. The markets will do whatever it wants to do. So your job is to manage your risk as the markets go. Okay, so to conclude, how to trade the art to conclude the art of counter trend trading without blowing up. Those are the techniques you can use. How I personally do it is I don't counter trade. I don't counter trade at all. Even if I see a setup that shows me that there's going to be a pullback, I try not to counter trade. I try to wait it out. I try to wait until it's over before I finally jump in. Okay, I'm going into the next topic for today. Let me just check the Vantage app to see if I missed any questions and answers questions. Okay, sorry, people on Vantage app. I keep scrolling up to look for your chat, but the chat keeps moving and it keeps bringing me back down. So I'm sorry if you have a message, you want to talk to me, you have something to say to me. Every time I scroll up and every time there's a new message, I get brought back down to the newest message. So, hi. Okay, I see someone saying hi. Hi. Habs. Love. Okay. At least I see someone's message amidst the crazy moving chat on the Vantage app. Okay, those who are on Vantage app, if you really have a question, hello. If you really have a question for me, okay, and you want me to answer it, just keep spamming, just keep copying and pasting your question on the chat. And the next time I look at the chat, hopefully I see your chat. Hello. Okay. I'm gonna move on. So next topic is indicators that actually work for trend identification. This is an indicator. Whatever I'm sharing with you guys are things that I personally actually use. There are many out there that you can use to identify trend, but I personally use this, and this is what I wanted to share with you guys today. So the first one is the classic trend filter, which is the moving average. Let's start with the most widely used and frankly the most reliable trend indicator, which is the moving average. Moving averages are designed to smooth out the noise in the market. Instead of reacting to every little wiggle of price, the moving average gives you a cleaner view of direction, a simple rule. Sorry, give me a moment. Just trying to see. Okay, hi Nina, always joining your sessions, learning a lot. Okay, I just saw that message. Okay, those who are on Zoom, If you can you chat with me on the chat box rather than the Q&A box so that I don't need to monitor so many chats? Because right now I need to monitor the chat box on Zoom, the Q&A box on Zoom, and also the crazy moving chat on Vantage app. Okay, so let's just stick to one place for Zoom, and then for Vantage app, I'll try my best to catch your questions amidst this crazy moving chat. Okay, so again, the moving average is designed to smooth out the noise in the market. Instead of reacting to every little wiggle of price, they give you a cleaner view of direction. A simple rule: if price is trading above the key moving average, you can see on the charts, I mean the picture that I've attached, okay, like the 50-day or the 200-day moving average, the trend is likely up, okay? If it's below, the trend is likely down. But the moving average are more than just directional guides. They often act as dynamic support and resistance. If a strong uptrend In a strong uptrend, price frequently pulls back to the moving average before bouncing higher again. In a downtrend, the moving average often caps rallies and pushes price lower. So crossovers are also powerful clues. For instance, when the 50 EMA crosses above the 200 EMA, that's called a golden cross, suggesting a shift of bullish conditions. The opposite is called the death cross, warning of bearish conditions. So the red in this example is the 20 EMA. And then the blue is the 50. But I mean, you guys can use other settings. The other settings that I usually use is the 50 and the 100. Okay, but this is just an example to show you that you should use one with lower settings and one with a higher number in the settings. Okay, so yeah, when you see the blue below the red, right, it is a suggestion that we are on an uptrend. If the blue is above the red, it's a suggestion that we are on a downtrend. Okay, it's literally that simple. Okay, so the trick is not to treat moving averages as a magic signals, but more like a filter, more like an assistant, more like a second opinion. Okay, they tell you the overall environment. If you align your trades with the moving average direction, you're trading with the flow, not against it. Okay, so far so good with the moving average. Anyone has a question? Okay, I've got a question here. When trading counter trend, how do you decide between fading a move or simply waiting for the new trend to establish? Very good question, actually. That's a very when trading counter trend, how do you decide between fading a move or simply waiting for the new trend to establish? Okay. I think that comes down to context. If you see exhaustion, okay, like diversions or long wicks or failed higher highs, you can try a very small counter trend fade. But if the signs aren't clear, right? They're not very clear, it's safer to just wait, to just, stay out and trade once the reversal proves itself with a new structure. Okay? Okay, I've got another question here. Is there ever a point where you should abandon trend following because a trend is too mature? I get what you mean. You are thinking like, oh, okay, it's making higher highs. It's like gold is so high now, and like, I shouldn't get it. Okay, so to answer you, yes, if there are indications to abandon it. You don't just abandon it just because you feel like price. Okay, you look at gold right now. Gold is trading at, let me see. I can't remember what gold is trading at. Okay, but I remember it's really high. Okay, so let's say, okay, Bitcoin, for example. Bitcoin's a very good example. Bitcoin is $115,000. You're like, oh my God, it's so high now. I shouldn't even get in because it's so high. No, you should only not get in if the trend shows signs of exhaustion, right? Price can keep going up. It can go up to 200,000 if it wants to, but don't get in if there is signs that there's exhaustion. Okay, so smaller candles, slowing momentum, volume divergence, or repeated failures to make new highs or lows, it's often best to avoid chasing. So late entries usually come with poor risk reward, so better to wait for the next cycle than to chase whatever it is you're chasing. Okay, another question here is, how can you balance between trend following indicators and price action, like the moving average? Okay, I like to combine things together, and then that's where it's called like correlation. Hold on, guys. Let me just delete whatever is on the charts. Erase everything. Okay, there you go. Okay, so it's correlation. So this is an example that I like to use. I don't know if it makes sense to you guys, but basically, let's say you go into a shop and then you want to buy a jacket and you don't know if that jacket is suitable for you. You don't know if it looks good on you, right? So then the jacket is pink, by the way. So then you ask your mom, like, hey, mom, like, do you think this jacket looks good on you, on me? And then your mom's like, yes, that jacket looks good on you. Okay, so you've got your first indicator that is telling you that your trade, your idea is safe. So your mom is telling you, yes, your idea is good, get the pink jacket, it looks good on you. So then you ask your dad, and your dad is like, no, the pink jacket doesn't suit your skin tone. Okay, so that's kind of like getting another indicator, and the indicator is telling you, no, I know you think this is a good idea, but no, it's not a good idea. Okay, so maybe your mom is the moving average telling you that price is moving in an uptrend, but then you pull out RSI, and RSI is telling you that it's moving in a downtrend. Okay, so that's when you, to answer your question, how can you balance between trend following indicators like moving average and price action? You just combine them together and use them both as like data collection, and then you decide if you want to move forward with the data and the advice or whatever the indicators and price action is telling you. But to be very fair, I will always put price action first. So let's say you're asking your mom a fashion question. If your mom answers yes, that makeup looks good on you, because she's a woman and she will know better about makeup, or I mean, some men know very well about makeup as well. Okay, she's a woman, and you take her advice more strongly than if you would have asked your brother, because your brother doesn't use makeup and he doesn't know very much about makeup. So for me, price action will always have a better, like, opinion, a stronger say than indicators. Okay, but that's for me. I cannot say the same for all traders, but I personally put price action above indicators. So for me, it's always going to be price action first, then trend, then indicator, then yada yada yada, then fundamental analysis or whatever it is. Okay. Yeah, so price action should always come first. Indicators like moving averages are just filters. If the structure says that the trend is intact and the moving average confirms it, you have alignment. Okay, if the indicator says one thing and price action says another, then for me, I just trust the charts. Okay. Okay, moving on. Okay, so let's talk about, oh, sorry, I actually added it in. Okay, let's talk about how actually using indicators in the right way. The biggest mistake traders make is treating indicators as signals in isolation. For example, they buy just because two moving averages crossed, and they sell just because ADX is high, for example, or RSI and like stochastics has reached a resistance, whatever it is. Okay, the approach almost always fails. I mean, sometimes you make money, but like a lot of times you find out it doesn't work. Indicators are at their best when used as confirmation tools, not decision makers. Okay, not decision makers. They're just confirmations. They're just second opinions. Okay, always start with your price action, like support, resistance, structure, and candlesticks. Okay, once you've identified a possible setup, then check the indicators. If the moving averages agree with the direction, or if an indicator, ADX for example, confirm that there's enough strength behind the move, then you have a higher probability trade. Another important principle is to avoid indicator overload. You don't need 10 different indicators on your chart. Too many will give you conflicting signals. Keep it simple. Keep it simple. Use 2 or 3, ideally one that complements each other. The best traders in the world have clean charts. Okay, my charts are super duper clean. Okay, indicators are there to give you confidence, not to replace your analysis. If you think of price action as the main meal, indicators are just the seasoning. Okay, they make the dish stronger, but they're not the dish itself. Okay, so this is one that I like to use for trend reversal. So for those who have been following me for a while, you know that I am an Elliott wave trader. I love Elliott wave. I have made so much money using Elliott wave. I just made some money recently using Elliott wave. I made 300% on Ethereum using Elliott wave. Okay, so Elliott wave is basically this indicator where Mr. Elliott, I don't know his first name. I cannot remember his first name. Something Elliott, Mr. Elliott, he went on the charts, he was doing analysis, he's just studying the charts, and he noticed price is constantly moving on a 5-wave pattern. 1, 2, 3, 4, 5. After a 5-wave pattern, it pulls back in the ABC. Once the ABC is done, so 1, 2, 3, 4, 5, exactly like the example I placed, followed by A, B, C, which is a zigzag pattern, and then continuation of the 1, 2, 3, 4, 5 in whatever trend that price is moving in. So I like trading this way because it has made me a lot of money. The strategy works for me. I cannot say it works for everyone, but it works for me. Okay, so 1, 2, 3, 4, 5, and then followed by A, B, C. So in 2 and 4, okay, 1, 3, and 5 is always following trend. 2 and 4 is always counter trend because price is constantly moving in a zigzag. Why is it moving in a zigzag? Because it needs to pull back, right? You can't have price shooting up all the time. That's just not right. Okay, you need price to keep pulling back to come back to a better entry, then you can get in. So 2 and 4 are usually the counter trend, and ABC is usually the counter trend. Okay, because technically this is a 1, this is a big 1, and this is a 2. Okay, because 1, 2, 3, 4, 5. Within 1, 2, 3, 4, 5, there is 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay, so there's always subwaves within subwaves. So basically, it's 1, 2, 3, 4, 5, followed by a pullback of ABC. So using Elliott wave, you can identify when the trend reversal will happen, when the counter trend will happen. That for me is a very good way, okay, of identifying it. Okay, I love using Elliott wave. I vouch for Elliott wave because I have made so much money from Elliott wave, consistently making money from Elliott wave. Okay, so I vouch for Elliott wave, and I vouch for using Elliott wave to understanding counter trends and to understanding trends. Okay, so if you guys want to study Elliott wave, you can, but I definitely cannot talk more about Elliott wave in today's webinar because we only have 8 more minutes. Actually, we only have 5 more minutes because I started today's webinar early. I might get kicked out in the 1 hour mark because I started at 4:55. So usually Zoom will kick me out 1 hour later, but we'll find out in a while. I'll just try my best to answer everything and finish the slides before I get kicked out before that 1 hour mark. So I've got 5 more minutes. Okay, let's just finish the next one. So building a risk management plan, you'll actually follow. Sorry, that is not the correct topic for today. This is not the correct topic. It should be when to switch between trend and range strategy. Sorry, I think I didn't change that slide from the last time I took you guys, which was what, last week. Okay, this was when to follow trend and when to go counter trend. Okay, so recognizing market phases, one of the hardest skills in trading isn't just spotting trend, it's knowing when trend is ending and when the market is shifting into a different phase. So markets don't trend forever. They move in cycles, strong cycles, okay? Strong trends, followed by periods of consolidations or ranging. Before another trend emerges, in an uptrend, you'll see higher highs and higher lows. In a downtrend, lower highs and lower lows. But in a range, you'll see equal highs and equal lows. Price just oscillates between support and resistance. Why does this happen? Because no strategy works in every phase. A trend following strategy that works beautifully when momentum is strong will bleed slowly to death if you keep applying it in a choppy sideways market. Conversely, a range strategy that makes steady gains is consolidating with will get destroyed if you keep fading moves in a breakout trend. So the first step to switching strategies is recognizing that what phase the market is currently in. It is trending. Is it trending? You have to ask yourself. Is it ranging? Is it transitioning? You need to ask yourself these questions. Get the context right, and your chances of survival improves dramatically. Okay, so how do you actually spot when trend is losing steam and about to shift? The first clue is loss of momentum. In an uptrend, the new highs are weaker than the previous ones, and candles get smaller and struggle to close higher. In a red flag, okay, it's a red flag. The same in a downtrend. If new lows can extend strongly, sellers may be running out of energy. Okay, so secondly, watch for failed structure. In an uptrend, if price fails to make a new higher high and instead breaks below the last higher low, that's often the first signal a range or reversal is starting. These structural failures are early warnings. So third, use a volume as a guide. I didn't include that in the slides, but you can use volume as a guide. In ranges, volume tend to drop because fewer participants are interested. In breakouts, volume spikes as big players pile in. The shift is participation is a key signal that the phase is changing. And fourth, as we discussed earlier, indicators can be useful. Okay, so use indicators to help you identify. Okay, so once you recognize the phase of the market, the next step is adapting your strategy. Hey, give me a moment, guys. I've been talking too much. Hey, in a trending market, your job is to ride momentum. You want to get in with the trend. Use pullbacks to add positions and trail your stops to lock in profits as the market moves in your favor. So you're not looking to pick tops or bottoms. You're looking to go with the flow and let the market carry you. In a ranging market, the rules flip. Okay, your goal is to buy support and sell resistance. Okay, you're trading the oscillations, not the breakout. That means tighter stops, faster exits, and modest targets. The trend traders' patience become the range traders' quick hands. So the most important part is to switch when conditions change. Don't get stuck in one identity as a trader. If you are a trend trader in a range, you'll bleed slowly. If you're a range trader in a trend, you'll get steamrolled. The traders who survive long-term are not the ones who predict best, but the ones who adapt the fastest. Okay, so at the end of the day, trading is about survival. And survival comes from flexibility and discipline. Knowing when to switch gears, when to sit out, and when to press your edge is super duper important. Okay, so this is an example that I put. Imagine you're just getting in, you're following trend, and then you're getting in on a buy, you get in on a buy, a buy, a buy. Moving average now touches your candle crosses the moving average, and now this is your sign to get out. Okay, this is a sign that trend may have stopped, and you should get out. Okay, so that brings us to the end of today's webinar. I want to take the moment to sincerely thank every one of you for being here today. There's so many of you on the Vantage app. I think the last check was like 4,000 of you. Or was it 3,000 of you if I didn't say it wrongly? The 30 of you on Zoom, hello, thank you for coming by. You guys were a bit more quiet today. There were some very good questions, but you guys are usually a little bit more interactive on Zoom. But yeah, thanks for stopping by. Today that we've covered this topic, I know it's very basic, it's very simple, but it's very, very, very important. Remember, being able to identify trend will win you half the battle in trading. Okay, so please do take some time to learn how to identify trend if you haven't already. So just a last reminder, start small, start simple, but start implementing what you have learned today. Remember to protect your capital first, growth is second, because as long as your account survives, you will always have another chance. Without capital, the game is over immediately. And the risk management is what keeps you in the game long term to eventually win. Okay, and mastering your strategy. Okay, so once again, thank you for joining me for today's webinar. Stay disciplined, stay consistent, and I look forward to seeing you guys again next week. Until then, trade safe and may the markets be kind to you. Okay, bye guys. Take care. Bye bye. Thanks.